Well, obviously, interest rates affect balance sheets, which affect valuations going forward. But the big question out there right now is, has inflation peaked ahead of growth? Uh, and if that is in fact the case, and we're going to see that going forward in the month over month numbers, if that's decelerating, if we're still gaining month over month, but the rate at which we're gaining is decelerating, and we've already seen peak inflation, which is possible because we have some deflationary pressures coming into the system in the latter half of the year, then you're going to see tech outperform. Also, the fiscal stimulus, the infrastructure bill coming in, even though it's not as large as some would have thought, that puts pressure on interest rates. And so that interest rate tech correlation, or negative correlation, I should say, is playing out.
Francis, you mentioned the fiscal policy, the breakthrough that we got in the infrastructure talks last week. How much of that do you think has already been priced into the market?
I think it's largely been priced into the market. I don't think we're seeing much movement in the market around that, good, bad, wrong, or right. It's about, thus far, it's about half the size that maybe investors would have thought. But the thing is as fiscal starts to wane as far as the stimulus goes, and that's going to keep the Fed purchasing assets for longer, because if the fiscal side of things is, from a rate of change perspective, actually going into a tightening mode where it's adding less money at less of a rate, basically, then that's going to keep the impetus on the Fed to keep those asset purchases high and the rates low. Obviously, we have a record amount of debt service, so keeping those rates low is going to keep the recovery going, and markets are going to like that.
So Francis brings up the point about monetary policy. So I guess, Bill, question for you. I know you've been watching Fed speak. We did get a few speeches today, but I counted far fewer speeches this week than the flurry of commentary that we got last week. I'm glad we all survived that. But look, we went through a whole week of Fed speak after what's a pretty remarkable pivot in Fed communication without any sort of rip up in bond yields. So what's your interpretation of what's going on there? And do you think, for the most part, that we've avoided a taper tantrum, at least for now?
I do think we've avoided the taper tantrum for now. And I think you made a really good point, too. One of the ways we've characterized this, not just last week and the way the Fed handled it, but in months recently, is sort of a Jekyll and Hyde approach. They give you that more, in this scenario, was a more hawkish rhetoric, and then they even flushed it out further with Bullard on that Friday, and then you start to see it pare back just a little bit through that week, sort of a softer blow. What they're doing is probing the market, and they're probing it for its resolve, and really, but I've applauded the Fed for months. I'm definitely not a Fed critic. I do think they caved on their inflation expectations just a little bit due to a bunch of criticism. However, that's where the bonds reacted. The bonds reacted because the Fed basically had called for peak inflation. And to Francis's point, I think that's what the markets are pricing in right now, is that peak inflation. So I don't think anything really happens in a straight line. And things are still being digested at the moment. But I do think that last week was sort of that softer landing where the Fed they're coming out a little less hawkish, and now we're setting up into jobs. And so I'm really curious to see if we get that job growth that storms back, or it's another sort of lukewarm number. And that's what the markets are waiting for now.